Okay, so let me start with my little presentation here, and we'll go from there. Screen sharing. Okay, so here's this chapter is about depreciation, and what that really means is it's about how we deal with long-lived or long-term assets when we're having to deal with accrual-based accounting. The idea is we can't just record the cost of a big asset as an expense at the moment we buy it, because those assets are going to be used over several accounting periods, many years often. You know, if we buy a truck, we probably expect to use it for 5 to 10 years, depending on how much we'll use it, etc. So if we try to take the whole cost of the truck as an expense up front, it's going to skew our books. We're going to have this giant expense in the first year, and then no expense in the following years, even though we're using the asset to generate revenue throughout those other years. So the solution that accountants have come up with is something called depreciation. People tend to think of depreciation as a way to record the drop in value of an asset over time. And while it does seem to have that effect, that's not really the intent of it. The intent of depreciation is to spread out the cost of the asset over its useful life so that we can expense the asset equally, or not, sometimes not equally, we'll see a couple methods, but expense the asset over its useful life. So that's the intent. And if questions come up, or you just have a comment as you're listening to what I say, don't be afraid to jump in there. I won't be offended, or you can put it up in the chat as well, and I'll respond to it there. So when we're computing depreciation, in other words, how much expense we're going to take on an asset as throughout its useful life, there's a couple factors, or 3 factors really, we have to consider. The first is the cost of the asset. And that can include not only the cost to acquire it, but also any cost to get it ready for use. So if I buy a piece of equipment, it's not only the cost I paid for the equipment, but the cost of getting it shipped to me, the cost of getting it installed and ready to use. All of those are factored in. Sometimes we use the term capitalized in the cost of the asset. So that's the cost. The next factor we have to consider is the useful life. How long do we expect to use this asset or to generate revenue with the asset? Sometimes people think that means we're going to use an asset until it's completely used up, and that's not always true. A company like a rental car, like Enterprise Rent-A-Car, they keep their cars for like a year, and then they auction them off. And the reason they do that is because when people like to rent a car, they like to rent a relatively new car. And so for them, even though a car might really have a useful life of 5 or 10 years, depending on how much you drive it, for them the useful life is how long they expect to use the asset. So cost, useful life, and then salvage value. What do we expect the asset's value to be at the end of its useful life? Some assets will use up until they're pretty much trash, and then they'll have 0 salvage value. Others, like those rental cars, they might still be worth, we might pay $30,000 for them, and they still have a salvage value of $15,000 or something, because that's what we'll get at auction when we sell them off. So those are the 3 factors: cost, useful life, and salvage value. And in homework problems, those things will be provided for you because you'll need those to compute depreciation. All right, so for this book, there'll be 3 types or methods we'll use to depreciate assets. Just so you know, the vast majority of businesses use straight-line depreciation. And that's because the IRS has these schedules. It's called MACRS. Some people call it MACRS. And it's like Modified Adjusted Cost Recovery System or something. I just always see it abbreviated. Anyway, and that uses straight lines. So most people just use what the IRS puts out there, because then you don't ever have to worry about an auditor saying that's not a good method, because it's the method the IRS supports. So the 3 methods are straight line method, which we've already kind of had an idea about in some of the earlier work, a declining balance method, and then a units of activity method. So let me go into a couple of examples of each. So Bill's Pizzas purchases a small delivery truck. Probably should purchase a new business name, but hey, maybe some people, it's a good name for a little local pizzeria, Bill's Pizzas. Cost is $13,000. The expected salvage value is $1,000. And its estimated useful life in years is 5 years. And estimated useful life in miles is 100,000 miles. So that's all the data we'll need to compute depreciation using all three of these methodologies. All right, so the first is what's called the straight line method. So there's a basic formula for straight line depreciation, which is we take our cost minus our salvage value, and that gives us our depreciable cost, or sometimes you'll see it written as depreciable value, okay? That's the amount we're going to depreciate over the asset's useful life. Then our depreciable cost divided by our useful life will give us the amount of depreciation expense we'll take each year. So for this book, they have us always do depreciation for a year. Some businesses record depreciation expense monthly, but for our purposes, if it costs us $12,000, or if it costs $13,000 and we have a salvage value of $1,000, that gives us a $12,000 depreciable cost. Then we divide that depreciable cost by its useful life in years, and that gives us the amount of depreciation to expense each year. So here is a table, a depreciation table. And so you'll see that in the first year, 2017, we're gonna do depreciate $2,400 each year. And so these columns on here are the annual expense. So each year, at the end of the year, we'll do an entry to record depreciation expense on the debit, and then accumulated depreciation on the credit. Accumulated depreciation is a special account we use to keep track of depreciation. Accumulated depreciation is always linked to a specific asset. It is called a contra asset account. That means it's an asset account that goes with a specific asset, in this case, our delivery truck, and it records the amount of depreciation or the amount of annual expense we've taken against the truck's value. Our cost minus our accumulated depreciation is called our book value. So the book value of the asset is what you paid for it. And actually, it's your total cost, not your depreciable cost. So your total cost minus accumulated depreciation gives you the book value. So after the first year, their accumulated depreciation will be $2,400, and their book value will be $10,600. After the second year, so each year they're doing a $2,400 depreciation expense. The accumulated depreciation will be $4,800. The cost of $13,000 minus $4,800 gives us a book value of $8,200. So you'll see after the 5 years, what we'll be left with as our book value is our salvage value, what we anticipated up front the asset would be worth. That way, when we sell it off, if we really can sell it off for $1,000, we break even on the asset and we're good. That's just an estimate, so sometimes you'll get more for it than you thought you would, or sometimes less. Anyway, so that's the straight line method. In essence, we calculate the amount of depreciation, cost minus salvage value, depreciable cost divided by useful life, depreciation expense, and then we use that same amount each year. That's why it's straight line. It's the same amount of depreciation each year. Straight line method. Let's see. One thing to consider is we don't always purchase assets on January 1st, and so we'll have partial year depreciation. Let's see, I think we have a question. So the rate, good question. The rate, you'll notice the rate's the same each year, it's 20%. And really all they did to figure out that rate is they said how many years in its useful life, and this asset is 5 years. And so that means you're going to depreciate 1/5 of the asset's value each year. And so 1/5 is 20%. So to find the rate, all you do is you take 1 and divide it by the number of years you're going to depreciate the asset. Okay. So in this example, they bought the asset on April 1st. So in that first year, they're only going to, they have April through December, so they're only going to depreciate 9 months worth. So they'll take the annual depreciation expense, which was figured out through that straight line method, multiply it by 9/12, or 9 months out of 12, and that will give them a partial year's worth of depreciation, or 9 months worth in the first year. And then in the last year, they'll just do the first 3 months, January, February, and March of that last year. So it still ends up doing a whole 5 years worth of depreciation, but it accounts for the fact that we didn't start in January, so it was a partial year at the beginning and a partial year at the end. All right, so the second method is called a declining balance method, and it's actually part of a whole family of depreciation methods that are called accelerated depreciation methods. We use these because we recognize that some assets really get used up more in the first year than they do it in the second year. You can think of that even with a car, right? If you have a car that's a year old, it's worth a lot less than it was brand new, and then the value sort of goes down at a lesser rate at that point. So with the declining balance method, what we do is we figure out that rate, like was it Emery that asked in the last one, and then we use that rate and recalculate the amount each year. So I'll show you how to do that. All right. So the double decline, or the declining balance method, and then the one they're going to show us here is called a double declining balance. The first thing we do is we calculate our depreciation rate. And we do that by taking the number of years, so taking 1 and dividing it by the number of years that we're going to depreciate the asset. So if it's got a 5-year useful life, we'll take 1 divided by 5. That'll give us 0.2, or we're going to depreciate 20% of the value per year. But then we're going to double that because it's a double declining balance rate. Okay. Sometimes they'll do like a 1.5 declining balance rate, so you do 1.5 times the rate. But for this problem, and I think for this whole chapter, they always have you do double the basic rate. So again, useful life, 1 over useful life in years gives us the rate for our normal straight line depreciation, and then we double that rate. And so then the way we do this is we take our beginning book value, and you'll see in this case, we don't worry about salvage value. We take our whole cost, $13,000. We multiply it by the rate, 40%, and then that gives us an expense for that first year of $5,200. And since it's the first year, that's also our accumulated depreciation. Then we take our cost minus our accumulated depreciation, and that gives us the book value at the end of that year. It looks like they made an error on the slide because they have 7,800. This number should be the same going forward. In fact, that's such an egregious error. I'm actually going to come in here and fix it, lest it confuse us. Okay. I apologize that I didn't see that before. Okay, so in the second year, we start with our beginning book value, which will be the same as what it was at the end of last year. Then we multiply that by the same rate, 40%, and that gives us our expense for that year. So the reason it's called the declining balance method is we're applying this rate to the book value as it declines. What this does is it lets us take a bigger chunk of the depreciation expense in the first years, and then it declines over time. We add our accumulated depreciation from last year to the depreciation expense we took this year to give us our new accumulated depreciation. And then we take that and subtract it from the cost, the original cost, to give us the ending book value for that year, for 2018. We carry that forward to be the beginning book value for 2019, multiply it by the rate to get the expense, add that to the accumulated depreciation from last year to have our total accumulated depreciation, subtract that from the cost to give us the book value at the end of the year. We repeat that process until we get to the last year. In the last year, instead of trying to calculate and multiply by the rate, what we do is we look at our beginning book value, and then we remember I need to end up with $1,000 book value at the end because that was my salvage value. So in that last year, we just depreciate, take enough depreciation expense to bring our accumulated depreciation up to our depreciable cost, the amount we want to depreciate, which will leave us with the salvage value at the end. So that's the declining balance method, and more specifically, the double declining balance method. Same idea. If we start in the middle of the year, or in this case, we start on April, then in that first year, we calculate the amount of expense and then just multiply it by 9/12 because that's the number of months that we'll be depreciating for that year. And then in the following years, we follow the normal procedure. And then at the end, we follow the normal procedure, which is to depreciate enough to leave us with the desired ending book value. All right, one more method. And again, if you have questions, don't be afraid to ask. The final method here is what's called the units of activity method. Here, we recognize that some assets have they do have a useful life in years, but more importantly, they have a useful life in some unit of activity, like maybe a piece of machinery has a useful life of so many uses. Maybe a vehicle has a useful life of so many miles, which is actually more important to us than how old the vehicle is. And so sometimes they'll use a units of activity method. All of these methods are acceptable to the IRS. So the company gets to decide which works best for their system of keeping track of the asset. So to do the units of activity method, the first thing we do is figure out the depreciable cost, which is the cost minus the salvage value. And then we divide that by the total units of activity. If you remember, this truck, they decided, had a useful life of about 100,000 miles. That's as long as they wanted to keep it. So if we take our depreciable cost of 12,000, divide that by its life in units, 100,000 miles, that gives us a depreciation rate per unit, or in this case, 12 cents per mile. Then we take that depreciation rate or cost per unit, multiply it by the number of units of activity during the year, and that gives us our depreciation expense for the year. So here is a table. We'll see that our asset, again, had a beginning book value of, it doesn't show it on here, but it had a beginning book value of 13,000 because that was our cost. And then we'll take the number of miles driven times the rate. That gives us the expense in that first year. In that first year, since we had no accumulated depreciation before we started, then at the end of the year, our accumulated depreciation will equal that expense we took. And our book value will be the cost of 13,000 minus the accumulated depreciation. Second year, we repeat the process. This year they drove more miles, so we'll actually have more depreciation expense that year. And then we'll take the accumulated depreciation from last year plus any depreciation expense this year, which will give us our accumulated depreciation at the end of this year, 2018. Subtract that from the original cost of 13,000, and that gives us the book value. We repeat that process each year until we've driven the vehicle its useful life, which was 100,000 miles. So that's the units of activity method. And so management has to decide what they're going to use. You'll see that in the end, all three methods did the same thing. They allowed us to depreciate or take an expense for $12,000 of the $13,000 cost of the vehicle, leaving us with an ending book value of $1,000 for when we try to dispose of it, whether we're throwing it away or we're selling it or whatever we're doing with it. The straight line method took the same amount of expense every year. The declining balance method is accelerated, meaning it allowed us to take a larger amount of expense up front and then a declining amount over the useful life of the asset. And the units of activity method matched up with how we used the asset. So in years when we used it more, we had more expense, and in years where we used it less, we had less expense. And they're all three acceptable methods. And recognize what happens is depreciation is an expense on the income statement, so more expense means less net income. So for this, it spreads it out evenly. For this, we're going to have less net income in that first year and more net income in that ending year, because our expense will be higher in the first year and lower at the end. So that's a management decision. And that's really all. I'm like Forrest Gump. That's about all I have to say on that. Any questions or thoughts about anything I covered there? I know that was almost 7 minutes of pain.
So the 12,000, the total depreciation expense, is that like, does it equal the amount that you purchased the equipment for, or is it given to you? Where does that number come from?
Right. So the 12,000 is the amount you purchased it for minus any salvage value. And so in real life, you know how much you purchased an asset for, and then a salvage value is like an accounting decision. You just say, I think this is how much we think we can get for it at the end of its useful life. In a problem, like in a book, it's going to have to give you that information. It's going to have to say, this was the cost and this is the salvage value. Did that help at all?
Yeah, it did. I kind of forgot that that's how you got it.
Okay. So I'm going to stop sharing my screen for a minute. And I'm going to bring up my notes. So I take notes on the exams, which helps me when students say, hey, can you kind of go over what concepts I missed? I can't tell people specifics of the problems they missed. That's against the BYUI accounting department's rules. But I can go back to that checklist, right, where it says, here's all the concepts in the chapter, and then I can say, you missed these concepts. But in order to do that, what I have to do is line up those concepts to the exam questions, which is a process I go through just so I can better kind of review that with people. Why is this being... Okay, there it is. So here's a couple things I wanted to give you a heads up on. So first of all, if you can do a bank reconciliation, remember that way back? It seems like it was months ago, but it was really just a few chapters ago. So remember, the bank reconciliation is that process where you start where you have the bank's the bank's balance, which shows on the bank statement, and then the book balance, which is in your actual books that you're keeping as an accountant. And then you are adjusting the bank balance by adding in deposits in transit and subtracting out what are they called? Uncleared checks. I forget the term they use in the book. Anyway, and then adjusting if there's any bank errors. And then you're adjusting the book side by adding in any costs that you didn't know about till you got your bank statement, like maybe they charged you a service fee or something, or somebody wrote you a bad check. And then at the end, the two should balance. So remember, it was a few chapters ago. If you will understand that process completely and be able to work through one of those, and be prepared if they give you a multiple choice question to, on a piece of scratch paper, work it out, that will handle something like, let me see, 1, 2, 3, 4, 5. So something like, 5 or 6 questions out of 40. In other words, that's a big ticket item is what I'm getting at here. That's an important thing to know how to do and understand the process of the bank reconciliation. And again, what you have to try to do is think of it in terms of the way these exams do it, because it's not like the homework problem where it shows you almost like a bank statement or it tells you this. Instead, it'll be something like, you know, there'll be a, you know, there was an error of this much on this side of on the bank statement. How will this be handled? And you'll have to say, if there was an error on the bank statement, I'll have to adjust the bank balance. You know how and that's what's so hard about these tests, right? Is because you go from having like this visual cue in the homework to where it's more of like a verbal cue, and then they expect you to either, you know, build your own. And so when I take these tests, a strategy I have to use is I have to sort of write it out. Like if it asks me something about a journal entry, I will actually make the journal entry. Debit this account, credit this account. And then I have that in front of me as I answer the question. I think a lot of people try to do it in their head, and it's just, you know, some people are smarter than me and they can do that. I have to sort of keep things in order. So be prepared to be able to work out a bank reconciliation, and that's a big, like I said, a big ticket item on the exam. Another one, another bullet point that's on the exam preparation checklist is understand the principles of internal control activities. And honestly, that is like, more than it's a problem, it's like those book learning questions, right? Like it'll be like, which principle of internal control activities applies here? And there's, again, 1, 2, 3, 4, I think 4 or 5 questions on the exam over that topic. So if you'll just study those hard, you know, those 2 concepts that I just gave you, that's 25% of the exam right there. That's 10 questions out of 40. And again, I'm not trying to give it away. The checklist tells you those items are on there. I'm just saying those get hit pretty hard on the exam. And let me see if there was anything else that I really thought bore. So this chapter where they talk about depreciation, and then they also talk about something called amortization. And amortization is the same thing as depreciation, except we call it depreciation when we're working with fixed assets or long-term assets. And we call it amortization when we're working with intangible assets, things like patents or copyrights. So if I know a patent has 20 years before the patent expires, again, I'll take the cost of developing the patent, divide that by its useful life of 20 years, and then take expense for some of it each year. So knowing how to do that process for the 3 things I just went over, so straight line, declining balance, and units of production, and then recognize that amortization is the same process, except for intangible assets as opposed to long fixed assets. That takes up another 5 or 6 questions of the exam. So those are the 3 biggest items. What helps me is to pull up that exam preparation checklist. Does everybody know where to find that? I showed it to you before. Aaron, I see you nodding. Emery, I see you nodding. And Hazel, I just have to go. I can't see you, so I just see your name. But yes, she says, okay. So if I take that checklist, it's like bullet pointed list, and then I go to the self-tests, the ones that are in that additional study content I provide you, and I sort of like go through those self-test questions, and then I look at those and like compare them to the checklist, and I'm like, okay, so this is how they're going to ask me about these topics. And that really helps me in my preparation, because the exam is different enough, even though the concepts are all the same, but different enough from the homework, that thinking a little bit about how are they going to ask me about this? Like, how are we going to frame a question about bank reconciliation in a multiple choice or in a fill in the blank setting? Or how are we going to frame a question about depreciation? You know, maybe they'll give me that table and then say, fill in this last part. Or maybe they'll just say, this asset has a useful life of this long and a cost of this much. And I'm using the declining balance method, and how much will be my depreciation expense in the 3rd year. And the only way for me to do that is to actually go through the process of creating that depreciation table, right? so that I know how much the third year depreciation expense is. So you have to know the material well enough that you can do that for it. I know that you guys know this already, but I'm just saying, this is how I go about preparing for the exam, is looking at the self-test questions, which are made by the textbook publisher, and they're drawn from the old book version, but the same pool that these exam questions were drawn for, out of a new pool of questions. And so they just feel and look a lot more like it. And then comparing it to the concepts helps me think, okay, so I need to understand this maybe from a slightly different angle than how I had to understand it for the homework. Is that helpful at all? That's just the process I use. I was working on a PhD and had to go back, and they made me take, they called it like a graduate level financial and managerial accounting. And I swear it was the exact same stuff that I cover in these classes I've been teaching for years. And so I had to go back to it and be a student in it again. And I finally just texted the teacher and was like, how about this? How about I will answer all the questions in the discussion board and just help the other students through it, since I teach this class. And then you don't have to do any of that, and I don't have to do any of the homework. And the teacher was like, yes, that seems like so. So that worked out for us. I taught his class for him, and he didn't make me do all the busy work. I just took the test. I can't make that same deal with you. I'm sorry. I got lucky on that one. All right. So that was probably me talking for too long. And so I would turn the time over. Does anybody have any questions about specific homework problems, or just general questions I can try to answer for you? Or are we good? Okay, well, it sounds like there's no questions, so that's good. So with that, I guess if there's nothing else, we can finish up. I don't know if you guys saw that President Nelson is going to do a little message tomorrow. I hope you're not like me. Sometimes I tend to get like cynical, like another thing to have to deal with. And so and then I remember, wait a minute, this is a prophet of God who wants to speak to me, right? So then I get humbled by my cruddy attitude. It's the same thing with like devotional, right? Where I'm like, yeah, I should watch that, but I'm busy. It's another thing. And granted, devotional is just some regular person a lot of times, not a prophet of God. Every once in a while we're lucky and we get one of those. So I'm repenting, and I'm going to listen to what a prophet has to say, especially as we live in a world that is desperately in need of peace, and that peace doesn't come through governments, and it doesn't come through presidential elections, but it does come through the Spirit of the Lord. And so I'm looking forward to that. The little college I teach at here in Arizona, we have an institute with 4 wards. And so every once in a while, as a faculty member here at the college, we'll get asked to go speak at devotional. And so always what I do is I look up who's speaking like at Provo that week, or who's speaking at BYU Idaho. And I start my talk that way, like, hey, if you were at Provo, you would have Jeffrey R. Holland, but instead you get me. And that always sets the tone. That's, you take what you can get, I guess. Hey, Chelsea, we are just finishing up, actually. No, you don't have to apologize. I was just setting expectations clearly, so that when I said, hey, let's have a prayer, you weren't like, what?
I thought we were meeting at 7:30, so it's my fault.
Oh, I'm sorry.
I read it wrong.
Yeah, and I changed. So we were on one schedule, and then my schedule changed, and I changed it a few weeks ago, and I apologize for that.
That's okay. I didn't check it till just now, so that's my fault.
And I saw somebody in the mid-semester feedback. I can't see who puts it ever. Of course, they keep it anonymous. But I saw somebody was like, the teacher needs to have the meeting at a time that actually works for people. And my problem is I've got 80 students, and no time actually works for. I have students in Africa, and I have students, and so this one, doing it at 6, I thought makes it 5 o'clock in California and 8 o'clock on the East Coast. And that covers most of North, Central, and South America within a reasonable time. I'm never going to get a time that works for the people on the far side of the world.
I'll help see record it so then we can watch it. So that's what I'll do for this one too.
All right. Well, again, I'm sorry.
No, it's my fault. Sorry.
So I did say the opening prayer, which means somebody's got to jump in on this one, because if you say 2 prayers in one day, I don't know, bad things. I don't know. I think good things happen, but anybody willing to jump in there and offer our closing prayer?
Let me close the door really quick.
I think she said she was going to close the door for prayer. I remember the days of little kids at my house where you needed to be quiet to say a prayer.
That wasn't good. Okay. Our Father in heaven, we're thankful for all the many blessings that thou hast given us. We're thankful for this time that we have had to meet together. We ask thee that as we study that we may have thy help and thy guidance, and that through the Spirit we will be able to remember the things that we have studied and learned. And these things we ask thee in the name of Jesus Christ. Amen.
Amen. And Chelsea, if you had like specific questions, something I can hang out and try to answer them, or if you had anything specific you wanted to talk about.
All of it still.
What's
so
that?
It's okay. All of it.
Okay.
It's okay. I'll watch the recording and then email if I have any questions.
Okay. All right. That works great. Then have a great night, everybody.
Thanks. You
Thanks
too.
for tuning in. Bye.